Hello, good evening, everyone. Myself, CA Ramanujan Sharma. First of all, I would like to sincerely thank our esteemed panelist, Mr. N.V. Balaji sir, Mr. R. Parthasarathy sir, M. Saravana Prabhu sir, and Mr. J. Srinivasan for joining us today and taking out their valuable time to share their knowledge and insight. I would also like to thank all our past participants for being here and making this discussion more meaningful with your presence. A special thanks to Shreyas Global for organizing this important panel discussion on 56th GST Council Meeting, GST 2.0. Let me introduce now briefly our panelist, Mr. N.V. Balaji, a practicing advocate at Madras High Court and across India, having more than 15 years of experience in various courts and former practicing CA for over 25 years of experience, representing Department of Income Tax, Government of India as senior standing counsel, a highly respected advocate with vast experience in litigation and arbitration, particularly in indirect tax and regulatory matters. We have Mr. R. Parthasarathy sir, who is a practicing advocate at Supreme Court of India, a well-known authority on trade remedy laws such as anti-dumping, subsidies, countervailing measures, safeguard, and WTO laws, an expert on indirect taxes, excise, VAT, service tax, GST, and customs. We have another panelist, Mr. Saravana Prabhu, who is a chartered accountant, cost accountant, and advocate by profession, executive partner and expert in indirect taxes and corporate advisory with deep experience in GST compliance and business structuring. And I would also like to congratulate him on the publishing his new book on GST Tribunal. Mr. J, we have our panelist J. Srinivasan, a leading authority on income tax, customs and foreign trade policy, bringing rich industry and policy level experience. A regular speaker at multiple forums like NASIN, GST Department, Custom Department, C&AG, and various trade associations. Now I think we can start with Mr. N.V. Balaji, sir, with your permission.
Sure.
A very good evening, sir.
Good evening.
On behalf of the participants, sir, my first question is to start, what is your general take on GST 2.0 proposal, sir?
I would say that this is much awaited change that had eventually happened. No, first and foremost, to see that there are multiple rates had difficulties in the past, both in terms of the issues leading to which rate to be applied, classifications, and the higher the rate, the issues with reference to inverted duty structures or the ITC credits were the issues, and the government has consciously taken a call, to reduce the rates to 2. That I think is a very welcome measure, both from the industry perspective as well as the practice, and also from the viewpoint of complaints. Of course, the third rate, which is at 40%, is an exceptional rate. So although currently the new rates would be 3-rate structure, I would genuinely believe that it is just a 2-rate structure that has been reduced. That's certainly a positive move to start with. Of course, there are bound to be certain teething troubles arising out of these. How we would manage is, or the government is likely to give it more clarifications on how it would be put into operation, the effective measures, at least as interim or something which we will have to wait and watch. Definitely a positive start. And I should also say the restructuring of the rates, reduction in rates, definitely ensure that the consumers as well would benefit, and the mechanism for requirement to approach the government for refunds, etc., could also come down. I think overall, I think it is what is overdue had at least started. I should say that.
Thank you very much, sir. My next question is from Mr. Parthasarathy, sir. Could you please highlight the major implication of these reforms for the auto and food sector, sir? Parthasarathy, sir.
Yeah. Thank you very much for the opportunity. First, I'll probably supplement what Mr. N.V. Balaji said before I come to the automotive sector. I think it's a very, very important reform, and I could consider this as the next most important reform after 1991, when we had the first structural reform, when we had 85% peak customs tariff, which was reduced in one stroke to 50%. And in 92, it came down to 35, and then thereafter to 25. And today we are standing at 5 and 7.5. And there are a lot of apprehensions at that time also, because of the steep reduction. There would be a tremendous loss of tax revenue and all that. But contrary to that, I think compliance and other things, economic activity increased so much. I think we were able to recoup that type of losses. In fact, we could get much more revenue than that. I think the same thing would apply here, making it very simple to simply 5 and 18. As I said, always in any other country also we have a higher rate for certain goods, we leave that. Essentially, it is 5 and 18. I think it's a very, very major reform. And I'm definitely feel that it is going to yield a lot more revenue and also results, and make it much easier for both the consumer and also the people. So that's the first thing I want to do, because after 1991, this is a very, very major thing. Now, as far as the automotive sector is concerned, I would say the most significant, most significant change, according to me, is reduction of rate from 28% to 18% for parts and accessories of motor vehicles falling under 8708, and parts and accessories of motorcycles falling under 8714. That is the most important change, according to me, because that was creating a lot of chaos in the last 4 years, where if any goods are classified differently under the tariff, but they were ultimately used in automobiles, a view was being held that it becomes a part and accessory of the motor vehicle, and they were all classified under 8708, and 28% was being charged. And we have, of course, notices pending for thousands of crores for many people who are ultimately serving the automotive sector. And most of it was also created by the Supreme Court judgment on the Westinghouse Saxby case. Based on that, they thought, fine, I don't bother about what your product is. Is its ultimate end use in automotive sector? If it is so, then it has to be classified under 8708. I think that was a major problem. I think that has been done away with one stroke. And correspondingly, what they have done also to carefully, engines which fall under 8407, 8408, they were taxed at 28%, they brought it down to 18%. Air conditioning machines, including air conditioners for motor vehicles, which are under 28%, they were brought down to 18%. Seats for motor cars, which were falling under 9401, were also brought down to 18%. I think they have done overall structuring to ensure that wherever is the classification, according to HSN, of a particular part of a motorcycle, if it falls under that also, it is 18. If it comes under 8708 also, or 8714 also, it is 18. So I think that one measure is going to reduce tremendous amount of litigation. So I would consider that as a very significant change as far as the automotive sector is concerned. Please go ahead.
Thank you very much, sir, for broader perspective. My next question is related to Chapter 87 again, sir, dealing with the automotive sector. What, according to you, is the one significant change, sir?
No, the significant change is what you are talking about, the other rates you are talking about, the motor vehicles, etc.
Yes, sir.
Motor vehicles, definitely one thing I find is electric motor vehicles, that 5% seems to have not been touched. So that will continue to remain. And there is a very significant reduction for, let's put the word, small cars. In the sense, if it is a petrol car or a CNG or LNG with a less than or equal to 1200 cc engine capacity and length is less than 4000 mm, which is 4 meters, they have reduced it significantly to 18%. So that is a very significant reduction. And we know a lot of people buy the small cars. So for them, there will be a tremendous reduction in price, which will happen. Similarly, For diesel engines of less than or equal to 1500 cc and length sub 4 meters, that also has become 18%. So that, according to me, it's a very, very significant change. The same thing applies for same length and same thing if it is even hybrid, that is got both CNG, it has got petrol and motor, electric motor, or diesel and electric motor also, you are getting 18%. So all other cars, so if it is more than 4000 mm length, or if it is more than 1200 mm for petrol engines, or more than 1500 mm cc for diesel engine, diesel motor vehicles, it all has become 40%. But even in those 40%, there is a reduction, because 28% plus compensation cess was always higher than 40% for all these cars. So even in those cases, there is a reduction. The reduction may not be as steep as from to 18% like in the case of small cars. But even in those cases, I think there has been a reduction. Therefore, overall, despite the fact that some of the cars are at 40%, there is still a reduction in the GST rate for those cars as well. So according to me, that again is very, very important. Of course, for agricultural purposes, the tractors have come down to 5%, and parts of many of those tractors have also come down to 5%. So I think overall, both from the agricultural tractor point of view, the motor vehicles, which is I'm talking about passenger cars, or motor vehicles for buses, etc., are more than 10%. In all these cases, I think there has been a rationalization and a reduction in the tax rate of most of the cars. The only thing is the difference. That's the only thing. Yeah.
Thank you very much for simplifying that, sir. My next question is to our panelist, Mr. M. Saravana Prabhu. Sir, can you please give a broad outline of the current issues in the intermediary sector before the 56th GST Council meet?
Right. So again, first of all, thank you to Shreyas for the opportunity for addressing. I think we have more than 100, and I think the number is increasing, so it's a great this one. So as far as, am I audible? Am I clear, Ramanujan?
Yes, sir. Please go ahead, sir.
So as far as the intermediary sector is concerned, I can say it is right from, if you even go before GST era, also service tax. Right from 2006, we had export of service rules, and even from that service tax era, even if you see the importance of this intermediaries, yesterday we have a case, if I am right, Sutherland. So, or one more case law has come in this very intermediary topic. So therefore, right in the context of service tax, I'm saying. So therefore, the service, this concept of intermediary has been a litigative issue right from service tax era. And we can say some problems have also transitioned to GST. So it's one of the, this one is issue is this intermediary. Now, where does the problem come, or what is the issue in this sector? Why is there such a lot of litigation here? So let's go to the background of the story. So the entire, this one, litigation stems from, we can say GST, it stems from whether this intermediary qualifies as an export of service or not, especially for outbound intermediary services from India to outside India. Take an example of that of a, let's say a selling agent, a buying agent, whoever it may be, who are servicing foreign customers. So let's say US, UK, Singapore. So they are the persons who are sitting there giving business to agents who are sitting in India for whatever purpose. So now the question comes whether these guys are intermediaries. So apparently, yes, if you look at the definition under section 2, read with this one 13 subsection 8, they come under intermediary, and therefore what happens is in that case, they would not qualify as export of service because the place of supply would be in India. If you look at 13.8, so one of the conditions of export of services is that the place of supply should be outside India. Whereas in these cases, because of 13.8, it becomes in India. Therefore, we had this problem of non-qualification of these services as export of service. And therefore, consequently, there was no refund given to them. And whatever export benefits were there were not available to them. And this problem spilled over to even if you look at other laws, FTP also, SEIS we had before, they were not entitled to it. Then later a clarification came that they could go for it. So all these issues were there. So whether these services qualify as export or not. Now this is fine, at least for these agents or brokers, or we can say such intermediaries, it's fine that the law was there. It was at least to some extent okay. But what happened was because of the wordings of the definition of the intermediary in section 2, subsection 513. So if you look at it, the definition seemed to cover, or we can say the interpretation was that if you ask me, the definition is actually quite clear. But the interpretation was that it covered all transactions where three parties were involved. If not all, many transactions where three parties were involved. So, for example, there were certain shipping companies who were doing services, etc. They were abroad customers. They were sought to brought into this ambit of intermediary. I can say there were other situations also like advertisement agents, so on and so forth. Leave aside agents, advertisement, normal advertisement consultant also, PR consultants also. So these guys were also sought to be brought into the fold of this intermediary. Believe it or not, one of the hotly debated DGJ topics or show cause notices. If just to put the things in context, if you look at GST law, this intermediary is the singular subject on which we have nearly 7 clarifications. Believe it or not, only 7 clarifications on which service qualifies as intermediary or not. Starting from Master Circular 159, Circular 230, 232, so on. So I'm right. 107 is also there. So there are 7 circulars which I can point out of my mind that these things are intermediary, these things are not intermediary. So much of clarification was required. So therefore, this was the controversy as to which of these services will come under intermediary. If they come under intermediary, there is no export benefit for them. So therefore, this was a litigation, and more so. And having seen that, there are again cases starting from Dharmendra Jani 1, 2 in the Bombay High Court is there. And apart from that, we have Material Recycling Association case law also covering this intermediary aspect. Because once you say it is not export of service, the next question comes whether CGST, SGST is payable or IGST is payable. So interplay between 13 and we have 7.5 also. So all these issues were there bundled together, and we can say it's a multitude of issues in the intermediary. So your question was, what was the issue before this GST 2.0? This was the issues facing the sector and allied sectors, we can say, because of this interpretational aspect of the definition of the term intermediary. So this is the precise issue. Ramanujan, you're on mute, so your voice is not audible.
Thank you very much, sir, for the clarification. And what will be the broad changes are brought only about with respect to outbound intermediary service, sir, and who will be benefited from this amendment?
Fine. So now I think your question is after GST 2.0, what has changed for this intermediary? Right, so I can say all this, whatever I've told so far, having said that, now I can confidently or joyously say that most of these issues will be put to rest. Because of a singular change in the law, which is 13.8b is removed, which said that the place of supply will be in India, therefore export benefits are not there. So that 13.8b is proposed to be removed, and therefore the general clause 13.2 will apply. If 13.2 applies, what happens is whatever I was saying right now. So the place of supply becomes outside India because the customer is in US, UK, Singapore, etc. So that location we'll have to see. General clause. So therefore, now it becomes an export of, rather the place of supply is outside India. Therefore, it qualifies as export under 2 subsection 6. And therefore, section 16 benefits you can claim, 0 rating benefits you can claim. So these for outbound, the intermediary services, we can say singularly because of a removal of a singular provision, we can say all these provisions have been, all these controversies to some extent comes to a end, and therefore it is very beneficial for them. They are now entitled to probably the export benefits in this regard. Again, you're on mute.
Thank you once again, sir. In this scenario, sir, can we say the most of the persons who are supplying these services from India will be benefited, and they can apply for the refund also earlier, which was not available, even they are getting foreign exchange?
Absolutely.
So now exactly throw some light, sir.
Yeah, absolutely. That's what I said, 0 rating benefits. So you have clarified it. Yes, absolutely. When we say 0 rating benefits, with payment of tax, without payment of tax, all sort of refunds, now they become entitled to. But having said that, I think we'll have to also deal with inbound intermediary service also. So it's not all rosy for them. So as far as inbound intermediary is concerned, the reverse applies. That is, now earlier the place of supply was outside India. Let's assume the reverse flip scenario, where we can say Indian or Indian people are procuring intermediary services from outside India. So it happens in some cases, for example, Spain or so on and so forth. An Indian principal is appointing an agent, sales agent or this purchase agent in Spain. So the service provider is outside India. Therefore, now because of this provision, the place of supply becomes India for inbound intermediary service. Therefore, now what happens? RCM gets triggered. So of course, we'll be able to take ITC benefit. That's a different aspect. But for those sectors where there's a partial exemption is there, or where the ITC is not fully passed through, so there we will see that there is some sort of a challenge with respect to claiming credit. Other than that, yes, RCM gets attracted for inbound intermediary service. So to answer your question, outbound, yes, export benefits are there, which includes refund also. And therefore, as far as inbound is concerned, RCM probably gets triggered, and ITC will have to see it is broadly available subject to the Act.
Thank you very much, sir, for simplifying that so clearly. My next question is to Mr. J. Srinivasan. Due to these rate changes, sir, what will be the impact and time of supply and documentation part, accounting? Would you please throw some light, sir?
Yeah. So, whenever there is change in rate of tax, we all know for a fact that Section 14 of CGST Act specifically deals with those circumstances. And we would have seen in the FAQ that was released, where again they have referred to Section 14 for change in rate of tax. So to simply put, if you want to identify what is the new rate that is applicable to your product in case there is an increase or decrease, I would simply put it this way: identify three events. Three events are: one is identify the date of supply, second, identify the date of invoice, third, identify the date of receipt of payment. So identify these three dates and look at the majority of the dates, whether it is falling before the change in rate of tax or after the change in rate of tax. If out of these three events, if two events fall before the change in rate of tax, then the old rate or the existing rate shall be applicable. In case the majority, that is out of these three dates, two of the dates fall after the change in rate of tax, then for the person there is a change in rate of tax, the new rate will apply. So that's how I will put it. Though it is not explicitly said so in Section 14, if you just interpret Section 14, this is how we can tabulate the change in rate of tax as per Section 14. Yes,
what will be the impact on the this? Thank you very much again for this clarification, sir. What will be the impact practically, sir, in respect of, for example, the goods returned or the goods already lying in stock?
Yeah.
And the payment which we have already made, for example, we have made some partial payment. So we would like to request you to throw some more light on this perspective also, sir.
Yeah, this partial payment is certainly an interesting issue. I'll address it as a second question. The first question, insofar as credit notes are concerned. See, as we all know, credit note is issued for an original supply under three circumstances: either where the value that you have charged in the invoice is higher than what is supposed to be charged, or the rate that you have charged is higher than what you are supposed to be charged, and any deficiency in services, any deficiency in goods, you return the goods, etc., for which you issue a credit note. What is to be noted here is, because the credit note pertains to an original supply, whatever was a rate that you adopted, when the return will also be at the same rate. If you had adopted the old rate, naturally the same rate will apply for the credit note as well. This is not a complicated question. But the second part that you have asked, what will happen in case of partial payment? That is certainly a tricky question, in as much as Section 14 does not directly address that scenario, because the term used in Section 14 is date of receipt of payment. So there can always be a scenario where a partial payment is received before the change in rate of tax, and remaining payment is received after the change in rate of tax. As I said at the outset, the majority event will be the decider for the rate of tax. But since payment falls in both the rates, that is old rate and new rate, I would think we have to divide this question itself into two parts. One is goods, second is services. Insofar as services are concerned, the law is very clear that you are supposed to pay GST on receipt of advances. Therefore, any which case on the advances, you would have paid GST. Therefore, old rate would have been applicable for the advances that you have received. And for the remaining payment that you receive, if one more event also falls after the change in rate of tax, you will adopt. That again is not a straightforward view. It's only derivation from section 14 read with section 12 and 13. The real issue arises on goods where you actually receive an advance because there is a notification which exempts time of supply on advance for goods. You would not have discharged any tax liability at the time of receipt of advance. The question that will arise is, after the change in rate, you receive the remaining money and you issue an invoice and supply the goods. Should you pay, should you discharge GST at the old rate for the amount that you received prior to the change in rate of tax? I would think goods definitely, because the time of supply does not get attracted on account of the notification being issued. In a case where payment is received even before the change in rate of tax, in case of goods, I would think that new rate will apply if other events are after the change in rate of tax. So again, this is definitely not, we cannot say that this is the view, but possible view. But according to us, according to me, certainly you can take a view that time of supply itself is postponed by virtue of notification. Therefore, to that extent, you need not pay GST at the old rate. Now, what is to be noted here is, it's not that all products are reduced from 18 to 5, 12 to 5, etc. There are products like, let's say, coal. It is now increased from 5 to 18%. So it's not that adopting this particular method, not adopting, etc., will always result in reduction of tax, etc. So there's always this. So therefore, what has to be made very clear is, in respect of goods, at least you can possibly take a view that you need not charge the old rate of tax as and when you receive advance. But insofar as services are concerned, given the fact that section 12 and 13 has an explanation which says whenever an advance is received, to that extent supply is deemed to have been made, is the language of the explanation. So therefore, when they say that supply is deemed to have been completed to the extent of receipt of advance, one has to conclude that supply is also before change in rate of tax to the extent of advance. Therefore, the rate of tax to be applied should be old rate to the extent of advance. So essentially what we are looking at is, you may have a scenario where you issue one invoice after the change in rate of tax with two rates. That scenario is not ruled out.
Just to supplement what Srinivasan said, see, the most important point, according to when you look at section 14, is they talk about invoice being raised on a particular date and payments being received. So whenever the word payment received is appearing, it means the full payment for that invoice. Therefore, if you are talking about partial payments being received, etc., probably we can consider the date on which the entire payment received as the date for the purpose of applying section 14. That's also one possible view possible, which is the reason probably where for goods, they have not asked for advance tax when you have payment of tax when you receive a partial payment or an advance, etc. Therefore, when section 14 talks about invoice, date of raising of the invoice, date of receipt of payment, and date of supply of the goods, the three aspects you take, whether they are before 22.9, whether they are after 22.9, you apply that. We talk about payment means full payment for that particular invoice is one way. Therefore, if you have paid 50% advance, but 50% of it is paid later, then we can probably take a view that that is the later date is what should be the date for the purpose of evaluating application of section 14. That's all probably I wanted to supplement what J. Srinivasan had said.
Yeah.
Thank you very much, sir, for shedding light on the legal angle as well. My next question is to our panelist, Mr. N.V. Balaji, sir. Sir, there is a proposal to rescind Circular 212, which provided a mechanism ensuring compliance with the condition of Section 15(3)(b)(2) of the CGST Act. What are the legal implications of rescinding a circular, sir?
For benefit of everyone, can you also tell the issues? I think post-supply discount is what you're...
Yeah. Sir, you are on mute. N.V. Balaji, sir. Balaji, sir, you are on mute actually.
So probably if JJ want to throw some light on it, sir. All right. So if JS, you want to throw, or sir, probably sir is, I'm not sure what the issues. It's on.
I think
mute,
it's
guess.
unmuted. Don't worry.
Yeah.
Yeah.
My
I
apologies.
would like to repeat the question again, sir.
I heard it. I heard
uh,
it. Not an
Thank
issue.
you, sir. So the
This
question
is-
is related to this post-sale discount, sir. Section
This is in
53(2)(b).
respect of
Thank you, sir.
post-sale discount that you have put
Right.
across the issue.
Right.
The section puts across this way that if there is a post-sale discount, then it will not be included into the part of taxable services if the person who received the service or the goods, as the case may be, he reverses the proportionate input tax. That is the expectation. And this is a legal requirement. To make the process clear, the circular was introduced to say that, certificate from the chartered accountant or the cost accountant would be required, so that you make the claim, and the department is able to at least they are at this stage they are not able to verify the authenticity or correctness of such reversal. Therefore, they want an external agency, a chartered accountant or cost accountant, to certify it. This is the purpose behind the existing circular. Now that is done away with. While this is a positive move, there are litigations now pending. I am talking about the earlier scenario prior to this proposal for withdrawal. There are cases where, for want of such certificates, no demands are being raised. I think this will have the withdrawal of the circular may have a bearing on such cases, because this is a positive move to ease out the difficulties that the assessees face. This move has been introduced. Therefore, the issue really would be whether such withdrawal is to be considered as a prospective one, or should it be applied even in respect of the cases which are pending, thereby whether it should be applied retrospectively also. While this could be litigious, I would only draw a few parallels. Supreme Court has time and again on many issues, particularly I would say on income tax section 43B, all of us know, if there is a failure to deduct tax at source, then expenditure will be disallowed, etc. In such cases, when the amendment came, when the other party pays, what will happen, etc. Their Supreme Court has, considered the view that, if there is an amendment that is made to ease out the existing difficulties, then it cannot be merely applied prospectively. It should be applied even retrospectively, when the period during which the difficulty itself was there. So considering this, I believe there would be a case for at least parties to say, mere fact that I did not have the chartered accountant certificate or the cost accountant certificate should not deny me of this difficulty. Therefore, I should also be entitled for what is the effect of. And by the way, this is not a statutory requirement. This was only a requirement that was put through the circular. The circular cannot travel beyond what even the law would say. I would, in fact, very honestly look for further views of Mr. Parthasarathy on this. This is my preliminary view.
Balaji, I have not really gone into the depth of the matter, but
Okay.
the fact remains, even earlier also, what you said, even in the excise, etc., when you talk about post-sale discount and all that, we have very clearly said the grant of the discount must be known to both parties before they enter into the agreement, that portion of it, and then it must be linked to the invoice. So
Okay.
if those two conditions you are able to fulfill even post this, you should be able to do, as you rightly said, whether a certificate from a chartered accountant or a cost accountant is mandatory, even when it is stated so in a circular. But if there is no dispute on the fact that the parties knew about the post-sale discount and it has been linked to the particular invoice, the absence of that particular is purely a procedural thing, and it should be condoned, was always the broad view which has been taken by the tribunals also. So I think the same should probably apply here as well.
I think in that case, the withdrawal of the certificate, the withdrawal of the circular justifies our thinking.
Yeah, correct. Absolutely. That's absolutely.
Thank you very much, sir. for clarifying this point. MSP sir, I think you would like to add something.
So just to supplement, again, just to give the viewers here a bit more context, one more amendment, if I'm right, para 7.1 of the press release which has come, has now probably changed the goalpost. What Parthasarathy was mentioning is two criteria is to be satisfied. One is that the discount should be probably known to the parties and should have been agreed before the supply has happened. And second is that it should be linked to the invoices. If I read the para 7.1 of the press release very carefully, it says that it proposes to omit that condition also. So wherein this credit note will be the only point or condition which is left off. Now what they're trying to say is that you issue a credit note even post supply. So that should take care. Probably we'll have to see the fine print. Again, Ramanujan, for the benefit of all the audience who are sitting here, these are only proposals which are laid out. We need to see the fine print of how the notification circular or the amendment in law comes in. So probably once that comes in, the views may have undergone a little bit of change also, just a small dispute. But if I see para 7.1 of the press release very carefully, these two conditions are also proposed to be relaxed, in which case it's a huge relaxation. The goalpost is not changing. So just to add some context.
Yeah, correct. I think what you pointed out is very important because the idea is to ease doing business. Therefore, they don't want probably even to have whether you agreed earlier or not. As long as you agree today to give that as a post-sale discount, we do not want to interfere. It is between the two of you. That seems to be the view. But as you rightly said, in all whatever we have stated, these are all from these documents, Appendix 1, 2, and the press release. How the final notifications come, whether in the there is any addition or subtraction, we'll have to see. And then if there is any modification of view, we probably have to send out a note to many of these people. Absolutely right. Yeah.
Thank you very much, sir. Just to conclude, MSP sir, could you please just explain briefly the situation before and after for the participant? What was the section, both the conditions for discount and like what after the proposed amendment? Although we'll have to keep in mind definitely the notification to be issued and the circular to be issued or any instruction at later stage.
So I think probably we'll be doing a lot of repetition because time is very limited, and I think
Parthasarathy and NVB 1 or 2 minutes, sir, if you can please add. Yeah.
All right. So to repeat, 15.3b is what we are talking about. So 15.3b has two clauses. We can say 1 and 2. So 15.3b1 says that if you are going to give a post-supply discount, suppose let's say it's an early payment discount you're giving, you have issued the invoice in let's say this month, let's say September, you are going to give this discount after let's say November or December, you are going to give the discount. Suppose they are making 1 month early payment, some discount like that, cash discount we used to call it. So that the condition was 15.3b1 says two conditions, which is one, you'll have to link the particular discount that is given to the agreement. Probably the agreement between the parties should have been such that if you pay early, so within like so many, 1 month you pay early, 15 days you pay early, 10 days you pay early, or 2 months you pay early, what is the discount? 1, 2, 3, 4, like that. Some mechanism of quantifying this discount, or at least a mention of this discount should have been there. So it should be linked to the agreement. Second, this particular thing discount should also be linked to the relevant invoice because you have issued the invoice in September itself. Now you are giving the discount in October or November. So therefore, you should link that discount to the relevant invoice originally issued. Second condition. The third condition is that is what we are talking about right now. That SEBI sir was also rightly pointing out. You are reducing your tax from 100 rupees to let's say 10 rupees. You are reducing and bring it to 90 rupees. 10 rupees you are reducing. Corresponding ITC should have been reversed by the recipient also because he had already claimed the ITC of 100. So now he'll have to reverse that 10 rupees ITC also. So for this 10 rupees ITC, how will be, the question was in that circular 212, sir was also trying to point out, was that how will you exactly see now audit is being done or assessment is being done of the supplier? How will the department know first of all? And second, how will the supplier himself know first of all that the recipient has reversed the ITC or not? So nobody will give this communication on a routine basis. Circular acknowledges this fact and says that we will introduce a mechanism how to verify. Pending that mechanism to be introduced, rely on the certificate of the CA or CMA, or it is less than 5 lakhs tax impact is there per person, then you rely on the self-certificate of the vendor itself. I think probably JS will also know this particular thing very well. There's one particular assessee or this one of our client of ours wherein the issue runs to nearly 1,000 credit notes spanning across 100 vendors minimum. 100 plus vendors, and the amount is in crores. If I say, can say hundreds of crores. So therefore, in this scenario spanning over 5 years, So in this scenario, how I can manually, physically, is it possible to go and get the certificate from all these vendors, even during assessment, which happens over 1 or 2 months, worst case scenario, 3 months to get over? Can I really produce all these, get these vendors, and as a legal maxim goes, the same concept is also there in ITC 2A, 3B, as all the members will also know. So therefore, now is it physically possible for me to have control over something that my recipient is going to do? That is the moot point here. So therefore, now the circular was giving this mechanism of getting the certificate, and this circular is now proposed to be rescinded, in which case the requirement of ITC reversal is still there. Please understand. But the certificate for proving that reversal is what is proposed to be removed. What is the mechanism that is going to be there introduced to replace that is another question. In my opinion, again, as Sir was also rightly saying, we have to see the fine print. I am saying that the supplier, if he has issued a credit note and that credit note is uploaded in the portal, my job ends. So that is the only requirement that I can satisfy. Recovery action can be taken only against the recipient. So that will be the goalpost that will be changing after the amendment is what I understand. But we'll have to wait and watch out. But as of now, the third condition, ITC reversal, to get the certificate, that condition is proposed to be removed. And after that, the other two conditions also, linking with the invoice, linking with the agreement, is also proposed to be omitted. And in which case, there will be only one condition which will remain. As long as you issue the credit note and that credit note is communicated through your returns to the recipient, your job should end. Therefore, compliance in this section probably could be relaxed to a large extent, is what I understand.
Thank you very much, sir. That's a very practical suggestion. My next question is to Mr. Partha, sir. What is your suggestion regarding the way forward for those vehicles for which the tax has been cut to 18% from 22nd, but have already been supplied to dealer at a high rate and are still not sold till 22nd, sir?
Okay. Now, my view is still I'm evaluating. So let's say, for example, I am a dealer in car. I have received the car supply much before 22/9, which means I have paid the tax at probably like 28% plus, let's say, another 14% compensation, so it's like 42% I have already paid to my car original manufacturer. Now I'm supplying the car after 22/9, and let's say the rate of tax has become 40, or let us say it has become 18. So earlier I had paid them something more than 40. And now after 22/9, it has either become 40 or it has become even 18, depending on whatever is the category of the particular car is concerned. So according to me, the law does not prohibit this as a situation of inverted duty structure. I have received my input on payment of tax at 28% plus 14%, let us say compensation says of 14% and 28% is the tax. So I have paid 42%. Let us say now I am supplying the goods at 18%. Now the problem in this type of situation is you have paid a duty at higher rate on your input, and the same input you are supplying it at lower rate. According to me, you should be able to get the refund of the higher amount paid on because of the inverted duty structure. But two things which allow to do that. One is, earlier it is not only a GST, it is also a compensation cess. And there is a requirement as far as the compensation cess is concerned, that credit has to be kept separately and that has to be utilized only towards payment of compensation cess, there is no cross utilization available. So to that extent, then you consider only that tax. The other is, it will be pointed out, there is a circular which says that in such type of situations where there is a reduction in rate for the same goods because of the change in rate, you are not eligible to get a refund under the inverted duty structure. Is a circular which has also been issued by the CBIC. That, according to me, is not correct, because under the law, all that it talks about inverted duty structure is the tax on inputs is higher than the tax on your output supply of goods or services. And it is not that that input should be used in some manufacture or something, all that input should be used in the furtherance of course of business, etc. Therefore, I have purchased a car paying a particular amount of tax at a particular rate. And when I supply it, actually the rate has reduced. Therefore, there is an inverted duty structure. I should be able to get the refund. I'm only now talking to the extent of the GST versus GST compensation says I'm keeping it separately. So despite the circular saying as if that in such types of situation you are not eligible for refund, according to me, it is not correct, because the law does not say inverted duty structure should arise in this particular manner. All that it says is what is your input? Is the ITC on that input higher? What is your output? Is it a lower direct duty? Then you are entitled to the refund. That's all that the law is talking about. So you should be able to do. The second important thing, for example, of all automobile manufacturers who are having this GST compensation cess is now the GST compensation cess is not there. You have only a rate of tax of 40%. Therefore, because the GST compensation, this were together earlier, and we were also having output tax to the extent we are utilizing it. Now that that is being done away with, we must have a representation to see whether the GST compensation cess could also be taken for the purpose of discharging the output liability when it comes to after 22.9. Otherwise, what will happen is you will have a situation that GST compensation will accumulate it, will be lying there, and finally it could get lapsed and it say you will not be allowed to do, in which case there would be a higher liability. And to that extent, again, whether the commensurate price reduction could be passed on, because there is finally a cost to that extent of the GST compensation, which is lying in my books. If I'm going to lapse it, I'm not going to get the benefit of that. So I will have to pass it on somewhere. It's not that I will have to suffer that particular loss. So in the entire scheme, the GST compensation cess, which is kept as a separate ITC to be utilized only, how that has to be done. If it is still kept to be separately and used only for that purpose, I think that's going to cause some more additional problems for the especially the transportation sector which were there. Otherwise, generally for 28 to 18 or 40 to 18, etc., I would say you may be able to get refund under the inverted duty structure. It may be litigative, but I think you have a very good case.
Thank you very much, sir. Since there is a significant rate reduction for many items, sir, will anti-profiteering will also apply, sir? Because that is also there was a sunset clause. So.
A very, very interesting question on section 171 on anti-profiteering. See, originally when it was introduced in 2017, it was based on the experience of many countries which have moved to a GST from a multiple taxes. They always felt whenever GST was introduced, a common GST was introduced from a multiple taxes, there has always been an inflationary problem. Therefore, they had to ensure that it's kept under control. Therefore, they were always said there must be a mechanism to ensure that any reduction in rate of tax or any higher input tax credit availability should result in a corresponding reduction in price. But in all those countries also, it was only a short-lived measure. Whereas in section 171, it was introduced and it was lying for some time. And we were also saying that it cannot continue forever, etc. So on 30th September 2024, we had a notification by which section 171 is not removed. Section 171 continues to remain on the statute book. All that it says is on and from 1/4/2025, no applications for under the anti-profiteering will be entertained. That's all that has been done. That position continues. If that position continues, now there is a tremendous reduction from 18 to 5 or 28 to 18. There is a lot of reduction, etc. One way is to say, okay, we leave it to the corporate sector to self-regulate themselves by passing on the benefit to them, etc. But because 171 is still on the statute book, and only by a notification that we said from 1/4/25 no application should be entertained, nothing prevents the government from issuing another notification saying because of the rate change from 22.9, from after 22.9, applications with reference to reductions which are brought about from 22.9 can be brought in. They can bring it out. Therefore, if that is not brought out also, my suggestion would be at least for the first 2 or 3 months after 22.9, try to pass on the any benefit in the reduction of the tax, etc., so that if later on suddenly 171 is revived, you are not put into a risk. Because generally for 1 or 2 months or 3 months maximum, you have to ensure that you pass on. Thereafter, the cost structures and others keep changing. You might have to increase your particular price. Therefore, as the law currently stands, 171 applications will not be entertained. Therefore, there is no statutory requirement that you should pass on the reduction by way of reduction in price. There is none. But government will definitely keep a watch. And if they find that the reductions are not being passed on to the consumer, there is a possibility of issuing a notification reviving that application status, because 171 is still on the statute book. So that's the point which I wanted to highlight. So everybody should take care for at least 2 months after 22/9, say till about November 30th, you pass on whatever is the benefit. Thereafter, of course, nothing is forever. So you can, based on your other costs and other factors, you can probably increase your prices. That's probably what I would say.
Yeah. So I just
Thanks
want
a lot.
to, Ramanujan, if you just permit me, just want to add one
Yes,
or
sir,
two
please.
points on this. This precise question was actually put to the finance minister and finance secretary during the press conference on the date of the briefing. So they said the following, just for the sake of audience. So they said totally the previous anti-profiting provisions 171 total cases booked were 704 cases, and they said 60% of the cases were booked during first 3 years of GST implementation. And they also added that the total dispute involved on account of anti-profiting was approximately 4,300 crores. So at the end, he said, because during the original implementation, this is the number we are looking at. They said the responsibility is cast on the business people to ensure that the benefits are passed on. And they finally added one line, which I do not know how to interpret. They finally said, in case we find out that there may be cases where they don't pass on, CBIC may administratively at central and state level will ensure that it is passed on. I do not know the meaning of whatever they have said at the end, but I'm just, thought of, highlighting this to the audience. So it's a self-compliance driven law. So the same is reiterated with the finance minister and secretary. So, and people can interpret in the way they want, but I thought of just highlighting this.
That's why I said the section is there. Notification power is always with me. That's the reason why I said, because we all keep watch for a few months. That's why I said if we would be are careful for about 2 to 3 months, I think that should really probably take care of it. Yeah.
I think that's the biggest takeaway. So the section 171.1 is there, still there. It says you will have to pass it on. Clear wordings are there. Just the complaint date is like sunset clause is there. They revive it, then yes, of course. Yeah, have to see.
Thank you so much, sir, for your insight. My next question is to Mr. M. Saravana Prabhu. What are the announcements, sir, with respect to the GST in this GST Council meeting, and what are the developments, sir?
So I think GST is something that has been long overdue, if I can use that word. After probably Madras tax bar, Madras, I will always say Madras tax bar, again, Madras per se has a rich history of, I can say, ensuring that the things are put up in a correct way. So courtesy Madras tax bar 1, Madras tax bar 2 and 3, this one. So the operation of the tribunal again has been kept pending for a long time, and now the pursuant to judgment in MTB 3, last year, if I'm right, 2024, the members of the tribunal, the conditions for their service, all these have been notified, rules 2024. So once that has been done, then later point of time, we have seen that the president has also, the GST president has also entered office in 2025. And then probably we are seeing now that finally the announcement has come, where we also saw probably a few weeks before, if I'm right, a week before precisely, or not more than 10 days, where we see that the members have also been appointed. And just so it's an open thing right now, which I'm able to see because it's there in the public domain also. The members have also taken oath. So the members from the center have also taken oath, and probably they're entering office also. So this is all this is happening. So in this context, this announcement has now come, wherein 3 important dates have been identified. So one is that of 30th September, before which it has been said that the GST will be enabled and the systems will be put in place to accept all appeals and applications. 30th of June. Second deadline is that of 30th of December, by which it has been suggested that the hearings will start happening. The benches will be functional at least to a large extent, and we'll see hearings happening. And having seen that the third deadline of 30th June 2026, which has been kept as the limitation for all pending backlog cases. So therefore, these three deadlines have been given in this particular announcement with regards to GST 80. Therefore, now we can at least see things moving in a very time-bound manner. So this is the as far as the GST 80 announcements which have come. So, but having said that, a lot of interesting aspects which are there, since you also pointed out, Shreyas publication is also there in GST 80 book, so which I would like to again show it to all the members here. So since you pointed it out, so we have covered these aspects in detail, wherein the GST 80 section 107 first appeal already we have been doing rounds with it for the last 4 years. But once section 112 is fully operational, and we can see that all practically operational rather, we will see that once you go before the tribunal, we'll have to be very, very careful with respect to a lot of things. To say a few things, we'll have to be careful as to what are the appealable orders. There are certain non-appealable orders, if I read section 121. So there are certain appealable orders, and even within the appealable orders, before what bench are you going to file these appeals? So therefore, we will see, especially we discussed place of supply matters today. So those matters will lie before the national bench, and you all know that there's also state benches which are constituted. So therefore, the national bench is now going to hear three things. One is with respect to those orders where even one of the issues pertain to place of supply is one of the matters. Anti-profiteering matter is another matter. As Parthasarathy was saying, we still have backlog of cases before 1/4/2025, before which the matters are still under investigation. So probably there the orders on those matters which are already pending, and probably, as Sir was also trying to point out, if it is brought back after some time, those matters also will be heard by the national bench. And third, the national bench will also, if I'm right, day before yesterday, a same announcement, in the same GST 2.0 announcement, we also seen that it will also act as the appellate authority for advance ruling, national appellate authority for advance ruling. So therefore, one more matter, because we see under 112, the government has been given power to notify such matters as the national bench may hear. So as of now, national bench is going to hear three matters, and all the other matters will be before the state benches. So which bench are you going to file the appeal? You have to be really careful. The limitation aspect is the next aspect. We have seen that the limitation goes hand in hand with recovery. So if you don't file the appeal before limitation, then recovery under section 79 by the department will kick in. There we also have to keep it in mind, a circular 224, which has now relaxes recovery, provided you pay this extra 10% pre-deposit. So limitation and recovery, both these aspects you'll have to keep it in mind. And apart from that, of course, we have other matters as to the filing forms and fees, and because you see that procedure rules are very detailed. This GST 80 procedure rules is one of, again, we can say, it has very, I can say, modern criminal laws which have been brought in. So in tune with that, we are seeing that we have researched this detail in our book also. The GST 80 is a new age rule which is going to last us for the next so many decades. So therefore, there are provisions there for a virtual deposition, virtual hearing. It is supposed to be paperless. So virtual depositions are even brought in there. So therefore, it's going to be a very, I can say, a high-tech electronic robust system which is contemplated under the GST 80 procedure rules. So all these have been also notified before this announcement. But yes, of course, as you rightly said, with these announcements, now I think we are having a very time-bound manner in which the GST 80 is going to be operationalized. And I think those members are all listening here. Any of your pending appeals which are there for the earlier matters, which you are not yet filed before the GST 80, now is the time for you to really analyze what matters I'm going to appeal further. What are the benches before which I have to file? Because you can't file it before a wrong bench. Then the limitation will run out before they reject it. Then we'll have to go to Limitation Act Section 15, and we'll have to go to writ remedy and get the matter reinstated before the correct bench. So the bench before which you have to file the matter, you'll have to be really careful about that. Pre-deposit, you'll have to start planning, because there are high value appeals which are there. Even though the maximum pre-deposit, maximum fees, all these have been notified, it is at a very high 40 crore which is prescribed. Therefore, you'll have to start planning for the pre-deposit. You'll have to start planning for the fees also, appeal fees also. And you'll have to, in general, plan your strategy for appeal also. So all these things becomes now very time-bound, and I request all the members sitting here to really look at your appeal pending list, especially when many matters are pending, and evaluate your this.
Yeah, just 1 or 2 points to add on. one thing which we have to notice, though the press brief says that the last date to file the appeal before the tribunal is 30th June 2026, but the fact remains there's a circular which talks about stay of recovery. That circular very categorically says from the date the tribunal takes over, 3 months is the time within which you are supposed to make the pre-deposit. Otherwise, stay is not there. So you may not. So it's not that if you make the pre-deposit and file the appeal by 30th June, you have a stay. For stay, there is still that circular which will apply. So the fact that the government has said by end of September and beginning of October, the benches will start functioning, etc. So we have to be very, very careful on that aspect as well. One. Yeah. So yeah, Ramanujan can go ahead.
Thank you very much, sir, for practical insights on GST 80 development, sir. As rightly mentioned by sir, these three perspectives are from place of supply and appellate authority for advance ruling. How do you see it from the perspective of companies having presence across India? Because there were multiple advance ruling by multiple like state.
Absolutely. So this is in fact why this National Appellate Authority for Advance Ruling was contemplated in the first place. It has not been operationalized so far. So now this GST 80 has been designated. We'll have to see the fine print also, but it has been designated in the press release as going to be operating as the National Appellate Authority for Advance Ruling also. So if you can recollect the provisions regarding National Appellate Authority for Advance Ruling, that also was visualized in a case where in the same assessee, but the provisions were a little restrictive, I can say, because it doesn't talk about the two different assessee on the same matter and two different rulings have been given. Let me repeat again so that it's very clear. Two different assessees or multiple assessees, same matter, but two different rulings have come. So therefore, those cases are still, if you ask me, if you look at the provisions regarding National Anti-Profiting Authority, they do not come before the National Profiteering. Then what does come before that one? Same assessee, same matter, two different rulings, probably for two different distinct branches, as you said, multi-state entities. So same assessee, same matter, two different distinct entities. That is two different GSTN numbers for the same entity. So in that case, you have multiple rulings. The matter was proposed to be before the National Appellate Authority for Advance Ruling. So probably whether this is going to remain the same or is it going to change, we'll have to see. Because if you ask me, on the same matter for different assessees, we have different rulings from different states. If you say the condition that the matters must pertain to the same assessee, then probably the scope will get restricted to a large extent, is my view. It was my view even then. So probably that is something we'll have to watch out for, whether in the same form, are they going to introduce it back, or are they going to change the provisions and are going to introduce it back, is something really we have to watch out for.
Yeah. And one more word of caution, just wanted to, since many people have joined here, insofar as the MSP sir was discussing about place of supply issues, there still remains an issue whether the underlying appeal is related to place of supply or not. We had sufficient number of advance rulings specifically on whether an advance ruling application can be admitted, because a place of supply issue can be seen as a taxability issue. If you frame the question differently, it can be seen as a place of supply issue if you frame the question differently. And we have a lot of intermediary, because we have intermediary. Yeah. Many notices and appeals, they are the only issue that is discussed is whether you're an intermediary or not. Place of supply is only discussed at the end of the conclusion, that export one of the condition you have not satisfied. So it's very important. Otherwise, what happens is, if you don't file an appeal before the national bench for the place of supply issue, so like MSP said, you will again go to the writ court and then get a direction for limitation, etc. So at least my suggestion is to file at both levels, because when in CSTAT we used to have some issues with respect to single member or DB, etc. We safer side we do both. So it's better that you go and file at both levels, especially because of the fact that we have had tens of advance rulings rejecting the application because the matter related to place of supply, again tens of advance ruling admitting the issue, saying that it is not a place of supply issue for identical facts or same facts, I would say. So it is very important that where to file an appeal is a very important question, which needs to be analyzed before filing an appeal before the national bench or the state bench.
Thank you very much once again, sir. I just wanted to ask this question, where to file, but you have already answered this question. So I have to change my next question. My next question to Mr. J. Srinivasan is, a practical issue arises when goods transition to being either nil rated or exempted, especially if the exemption applies only partially. This raises a question about the treatment of input tax credit on such supplies. Can you throw some light on this, sir?
Yeah. Again, once again, an issue where you don't have a straightforward answer in law. So basically, to just reframe your question with the 56th Council meeting, let's take two sectors. Sector one, we can take pharma sector, where some drugs which were earlier taxed at 5%, 12%, now it is exempted. Is one example. Second example is insurance sector, where certain policies are exempted, certain policies are still taxable. Now, in these two cases, the assessee or taxpayer will have a situation where one set of goods are exempted, one set of goods are not exempted, and same is the case for services. Now, if you look at the law, section 18.4 specifically deals with a transition mechanism, and 18.4 language says as follows. It says, wherever a registered person has been supplying goods or services which are taxable, now it is turned into an exempt supply. They are supposed to reverse the credit on in respect of inputs, in respect of capital goods, is what it says. And there is a proviso in that subsection which says the remaining credit which is unutilized shall lapse, is what that proviso says. Now, there is a fundamental question on when section 18.4 applies. This question arises because we already have a parallel provision for credit reversal under section 17.2. 17.2 fairly covers all scenarios where you have partially taxable supplies and partially exempt supplies. So how to harmoniously come up with an interpretation insofar as a product being taxable now becoming an exempt? I would say the following. If for a taxpayer, he was dealing only with taxable, now it has become exempt, no doubt for him 18.4 is directly applicable. The credits that he has essentially would lapse, and he is supposed to reverse the credit on inputs and capital goods. But for a person dealing with multi-products, like the insurance companies, invariably they'll be having insurance products that are taxable. Pharma companies, there will be drugs which will be subject to 5% or 18% as the case may be. In those cases, I would think that 18.4 will have no applicability for three reasons. One, if you look at the language of 18.4, it talks to taxable supply or exempt supply, qua the registered person, not qua the supply of goods or services per se. So that is one. Second, proviso will be made inapplicable because you're looking at a scenario where after reversing the credit on inputs, the remaining credit that is there in the unutilized in the ledger that is remaining unutilized, you will be supposed to reverse the entire credit if you are looking at a multi tax scenario. And third is the reversal also contemplates the word in respect of inputs, in respect of capital goods. So in a multi-product scenario, to identify or correlate the inputs directly for the items that are exempt, it may be very difficult. So for these three reasons, I feel wherever there's a multi-product scenario, you may have to still apply section 17.2. And one more reason is 17.2 is always independent. There could be a scenario where in multi-products, you reverse under 18.4, and you may still have to reverse under 17.2 because the formula is designed in such a way that yearly you have to do a reversal, monthly you have to do a reversal. So it's definitely not an answer which is straightforward coming out from the law. There is a requirement to harmoniously interpret these two provisions and then come out with an interpretation. And one more point is the erstwhile rule. If you look at excise law, rule 11, the language is completely different from that of 18.4. In fact, rule 11 has a categorical provision which talks about reversal of the entire credit you have after reversing specific credit in respect of inputs and input services, etc. So 11.4 versus what is there in 18.4, there is a complete divergence, I would say. So therefore, we cannot strictly take. There are some judgments, if you can look at in the context of rule 11, etc. I don't think those judgments could strictly be applied for 18.4 because the language is changed. The lapse, the credit that is to be lapsed, that is given in rule 11 of central excise and GST section 18.4, I see a significant difference. So therefore, this is an issue which will be there with respect to transition. It has to be addressed depending on whether you have multi-product or a single product or single line of service.
Yeah, just to supplement what J. Srinivasan was pointing out, see 18.4, as you said, harmonize. You look at section 18.4, it's very clear. It applies only to situations where you are having, I'm not talking about single, multi-product also it's possible, but all the products were taxable earlier and all the products have become exempt. In which case, all that they want is, because they become exempt, whatever input tax credit here, you cannot have them. So therefore, reversal, and then you are talking about expunging from them. Therefore, in a situation where you have 3 products, one of them has become exempt and 2 of them continue to be taxable, 18.4 is not the answer. Or in terms of 18.4, you will reverse the ITC pertaining to those inputs which have become 0, identify them and reverse, but you will not expend all the balance credit. For that, you will still have section 17.2, which is applicable. Therefore, you're right. The harmonization wise 18.4 proviso, especially when you are talking about, applies only at situation where you are dealing with products, all of which have become exempt, in which case, according to me, then there's no need for reversal or anything. All the credit has to be, in any case, exchanged. That's how it should have been done. So that interpretation, I think, is definitely possible, and I think it's a very, very plausible and correct interpretation also. Yeah.
Sir, just to add on to that, there are situations in 18.4, we can say to some extent, I can say, if I can use that, poorly drafted also. Why? Because even in a single supply situation, in certain aspects of certain industries, there is a lack of clarity. Single supply situation, in certain industries, there's a lack of clarity whether 18.4 is to be applied or not itself. Just to give an example here, I think those who are there in the hotel sector, hotel industry, so accommodation hotel, so those people who are there in the audience, I'm not sure whether they have really noticed this point or not. For rooms less than, if I have to see the thing correctly, rooms less than 7,500, now the rate has changed to 12%, if I'm right, 1 second. It has changed from 12% with ITC to 5% without ITC. So when we say it has changed from 12% with ITC to 5% without ITC for rooms less than 7,500, when 5% is without ITC, it is in the notification, if you look at it, tantamount to an exempt supply. So that is where now we are coming to Rule 18.4. So now how will we really apply this Rule 18.4 is the real question. Because there could be a situation where my supply for 6 months, it may be less than 7,500 only. 7th month, Navaratri, this is coming in Navaratri time also, all this amendment. Navaratri time, Diwali time, a lot of people are booking high demand. You will see that the rooms which are 2,500 are now going for 8,000, 9,000. So there could be a situation where in some of the month or even one odd situation where the tariff may go, actual tariff may go above 7,500. So therefore, consistently I've been doing business for the last 3 or 4 years. None of my rooms have exceeded the 7,500. Now I'll be tempted to think that I will now come under 5% without ITC only. Therefore, this Rule 18.4 will apply for me, even though I'm doing only one supply, and therefore I need to reverse my ITC. But the question comes when you are now going back to a situation where your supply is above 7,500 rupees. Should you, again, there is a provision for reclaim, 18.1D is there for reclaim of that one. But my question of why should I reverse in the first place and why should I reclaim later under 18.1D is also another pertinent question for those from the hotel industry who are there. And you're in category of less than 7,500 tariff, usually the case, then this 18.4 takes a new light for you, is what I'm trying.
Yeah, just to probably to conclude on the 18.4 topic, one more dichotomy that you could see in 18.4 is, while 18.4 main provision talks reversal only in respect of inputs and capital goods, it does not talk about reversal on input services. However, the proviso talks about remaining credit getting lapsed. So naturally, proviso cannot go beyond the main provision. So therefore, the lapsing should be in respect of inputs and capital goods alone, or should it also extend to input services? Again, an issue which is open. Like I said,
17.2 talks about input service.
Exactly. Like I said, excise law never had this issue. The language was very categorical. It said whatever is the remaining, you reduce everything and then everything becomes lapsed. But here it is introduced as a proviso and proviso talks about it. So therefore, certainly it leaves room for different possible interpretations. So one has to be careful in a case where you are taking a position that input service you need not reverse. Possible to take a view, but it is not very clear as to, law is not very clear as to what it is trying to contemplate by introducing such a provision.
I think this 18.4 versus 17.2 and multi was a single product and wholly was partly exempt. This could go on for like another hour or so. The litigations awaited.
Yeah.
Any other view, sir, or we can proceed further, sir?
Please.
Proceed.
Thank you, sir. Thank you very much once again. Our next question is to Mr. N.V. Balaji, sir. Sir, inversion is possible on closing stock on 21st September. For example, bought at 12% or 18% and sold at 5%. FAQ refers to circular 135 to say no refund, whereas the said circular has been read down in many cases, including Madras High Court, sir. What is your take on that, sir?
I think as you have rightly put across, the circular has been read down in the past, and this is an all India statute, and the department has not been in appeal. Therefore, the reading down has attained finality. That position would remain so, and therefore the question of, in fact, Mr. Parthasarathy sir has taken this earlier, that refunds cannot be denied. If now the circular, very circular, which has been read down, which has again not been appealed, cannot be used as a tool to say that we will not give you the refund. The department is less likely to accept, for they have come with a proposal to say that they are relying on such circular, and they look for not granting refund. While this could be litigious, I am confident that the court will ensure that the refunds are directed. The refund should come. Only thing is the assessees will have to grind the mill of running to the court, get their relief. Rather, the department itself, even at this stage, could re-clarify, ensure that having not filed further appeals, they should close the issue at this stage. That would well be done. I doubt whether it will be.
Thank you, sir. That perspective makes the issue much clearer. In addition to the same question, sir, although I think you have answered the same question, what are the implications in such a scenario where circular goes beyond the law, sir, which is also read down and is being reiterated to deny refund?
No, I believe it cannot be. That's my point.
Okay, sir. Thank you, sir. Our next question is to Mr. Partha, sir. What is your take on food sector, sir, in related to this rate reduction, sir?
See, whenever we say food sector, what we generally understand is all those goods which fall from Chapter 01 to Chapter 22 of the HSN or the customs tariff is what we normally covered broadly as the food sector. So that's a very broad classification. But in that, if you look at it, the current GST Council meetings and the decisions which have come, you have a lot of reductions, mainly 5% to nil, or 12% to 5%, 18% to nil, or 18% to 5. So these four major categories, there is a reduction. There are two categories where there is an increase from 18% to 40% and 28% to 40%. And this increase is generally with reference to all these aerated drinks, carbonated drinks, caffeinated drinks, or even non-alcoholic beverages, whether containing fruit or not, because that was a major litigation point. I'm talking about even in the S12 central excise regime also, whether something is a beverage or not, what is a beverage, etc. So in order to avoid, they have increased the rate on everything to 40%. So most of the items of these which fall under Chapter 22 of the tariff, which is the food sector, that has been increased to 18 to 40 and 28 to 40. But in all other cases, it has been a reduction from 18% or 12% to 5% or 0%. And in the process, they have also tried to rationalize. For example, you had milk exempt, but ultra high temperature heated milk not exempt. Now they have brought that also into zero, so that there is no dispute with reference to milk. Similarly, paneer, if it is desi paneer packaged, that also they brought down from 5 to 0. If it is cheese, which is not that typical to our paneer, but what we call in the Western world or Europe as a cheese, etc., that also they have reduced. Therefore, they generally, and the major problem with reference to even advanced ruling and all that is paratha, Malabar paratha, these all sorts of classification, advanced ruling problems, classified at 18%, they have brought it to 0. So generally, on the food sector, I would say there is a complete reduction in rate of taxes across the board. The only exceptions are the soft drinks, the aerated drinks, etc., which are falling under Chapter 22, and some items under Chapter 2106, which are under 40. Earlier, because 2106, which is the miscellaneous edible preparations, which is always a residual entry, attracted higher tax, there will always be classification dispute trying to bring everything under 2106 as a miscellaneous edible preparation, food preparations not elsewhere specified, etc. So that, according to me, again, tremendous amount of litigation would get reduced because of this rationalization of this particular rates. But consciously, they kept it 40% for various types of drinks, whether aerated, non-aerated, etc., falling under Chapter 22. They have kept it at 40%. So that is my overall take on the food sector.
Thank you very much, sir, for categorically covering a broader perspective for this sector. My next question is to Mr. M. Saravana Prabhu. Almost all the industries and distributor of goods have expressed aversion with respect to closing stock on 21st September and how this reduction in rate is going to impact such stock. Inventory management has become the need of the day. Your view, sir.
Right. So this is an issue, as you rightly pointed out, is there in auto sector. It is there in multiple sectors who are, especially we can say FMCG or consumer, direct consumer focused sectors are there. So this issue is very pertinent, that is of inventory management, especially since the rates have come down. Now, this problem gets complicated in a particular sector, which is that of pharma. So pharma, if you see, as Parthasarathy was also earlier saying, we have nearly 33 drugs which have now come to from 5 to nil under 30, tariff heading 30. And there are other drugs also which have now come to 5% from 12%, so a reduction of around 7%. Now, what happens is, please understand that the manufacturer of these drugs, original manufacturer of these drugs, would have already placed this inventory with the super distributor, who in turn would have placed the stock with the sub distributor, so on and so forth, till the end the stock is to the retailer. So the stock would be lying at various places. Now, what happens is, this pharma sector, why it is very unique is because, and to some extent, a lot of food related products also, it is all MRP regulated, and more so in pharma, it is also drug controller regulated. So you can't tinker around with the prices just like that. So you can't change the MRP as easily as you can do in food sector, or you can what is that? You can't change the price at which you sell to your this one also, super distributors also, so on. So there's a lot of regulation there in changing the prices. Therefore, the issue becomes even more complex. So this inventory management is the need of the day. So what happens is, these people who are holding stocks as on 21st September midnight, 11:59 to be precise, they would want to send back the stocks to you to the earlier stage, from the stockist to the sub distributor to super distributor to the wholesaler to the original manufacturer, so on and so forth. The reverse flow of stock will happen, or is what is proposed right now, I mean discussed right now, the reverse flow of stock, and re-invoicing that particular stock or resending that particular stock at the new or the reduced rate. So this is what is contemplated. But if this is happening, then what happens? One, logistical problems are there, transportation costs are there, all these needs to be factored in. So a small estimate says that probably even for the mid-size pharma companies, and the problem becomes very big in case of huge pharma companies, wherein the loss is expected to run in, or we can say the cost of this excise is expected to run in multi crores. So therefore, now comes the question: what are the ways in which the inventory needs to be managed, and so on and so forth? What is the strategy? Now, again, I will, for the benefit of the general audience, not take too much of time and probably still out all the strategy one by one. There are, of course, strategies legally where you have to manage this. Otherwise, you'll end up incurring that cost. So what happens is, of course, there is a dealer-to-dealer transferring you can do. See, wherever you can pass on the margin, you can pass on the margin. Very simple. So if you're feeling that there is some sort of an increased margin that you need to give to your super distributor or sub distributor, wherever possible, you can do that. But in pharma, it's very difficult. So the only other option is to take back the goods and return it without actual transfer. So I'm saying legally. So therefore, you would immediately wonder, what is this sending of the goods without transporting? It is very much possible legally also, which is very much possible. So what happens is this planning has to happen. Especially dealer-to-dealer transfers or stock, sending back the goods to your local office and pooling the stock, so on and so forth. All these strategies have to be worked out. And yeah, of course, so it's going to be a multi-pronged strategy, needless to say. But yes, this issue is a very pertinent issue that you have raised. And this issue gets complicated in sectors like pharma. So where we need to really take an action, like a step-by-step strategy we need to have, and ensure that this is a very, you can say, a less pain exercise, we can say, without going too much into the strategy. Yeah.
Thank you, sir, for highlighting such a practical and industry relevant point. My next question is to Mr. J. Srinivasan. Sir, there are some relaxation related to refund and registration. Your take on that, sir?
Yeah, one important relaxation or one important trade facilitation measure is we have been representing this consistently. While for exporters or supplies to SEZ, etc., you had this concept of provisional refund, whereby once you apply within a specified date, you receive 90% of the refund. Whereas in case of other refunds, especially inverted duty structure, we have cases where 1 year after date of application, there is no action taken because of various reasons. So one important measure that they have in fact come up with is even for inverted duty refunds, you will be granted refund of 90% provisionally. That is the most welcome step, I would say, because many inverted refunds, if you look at, invariably everywhere, central or state, it gets stuck up and they don't, because the documentation verification and everything takes a lot of time. That is taken as an excuse, and department simply gives a deficiency memo and the refund is never processed. So one thing is the measure about giving provisional refund of 90% to inverted duty is a most welcome thing. And in fact, the press conference, the finance secretary categorically said, though systems will be implemented only from 1st November 2025, they have very categorically said instructions are given to all the officers even before the actual date of system implementation to grant 90%, which very clearly makes the intention of the government very clear. So in fact, I would say even the pending inverted refunds, because of this statement, we have to press for provisional refund of 90%. That significantly removes working capital management, because for many companies, the working capital on account of this being stuck itself is very huge. Especially we had a lot of refunds being stuck on the textile industry, etc. So that is one trade facilitation which the government has brought in. And second, insofar as the registration is concerned, yes, we know for a fact that it was becoming a painful process for applying registration and getting a registration, though despite the fact that there was a consolidated circular which categorically lays down what officers should do in terms of verification of documents before granting registration, even though we face challenge of not granting registration for weeks together. And questions, some of the questions were very, very, what you call, completely irrelevant to what a registration application may otherwise require. So now the scheme that they are proposing is, they are saying 96% will be covered under the scheme. Basically, they say if a taxpayer has a tax liability of less than or equal to 2.5 lakhs per month, which is a quite substantial amount, there is an automatic clearance within 3 days of you applying. That is the most welcome step. We had this 3 days clearance when the GST law was introduced, because we had many instances of fake invoicing, etc. government went back to the old principle of granting registration after the officer is satisfied, quote unquote. So we had so many issues. We had to run to pillar to post, and we had a lot of big MNCs struggling to set up business. Everything is ready except for GS registration, and we had to, because in central there is a faceless GS registration. We do not even know whom to approach. So that those scenarios, I would think this new automatic system should address or will address. We do not know the fine print. They will come up with a scheme. So that again is a very good trade facilitation measure. As a statistics, it is mentioned in the press release that 96% of the registrations will go through this particular route. And the value also is very substantial. 2.5 lakhs is the value of tax they are looking at. So easily, depending on the tax rate, 3 to 6 crores is the turnover you are looking at. So I think that's absolutely a welcome measure. So these are the two things I would say insofar as refunds are concerned and with respect to the registration.
Thank you very much, sir, for covering this point. My next question, although very basic, I should have asked as the first question itself. What will be the effective date of applicability of these rate changes, sir?
Yeah, it is as it is stated very clearly in the press release. It is 22nd. See, one thing we have to very clearly put a standard disclaimer that there has been a consistent gap between the press releases and government documents that are released immediately after the GST Council versus what actually transpires in the notification. Let us be very, very clear that in the past, there have been huge gaps without any doubt. This time we hope so that there are no such gaps. Now, so therefore, though the press release says 22nd, and in the press conference also they say 22nd, that we can fairly assume. Of course, for certain products like pan, tobacco, etc., some specific products, the date is not 22nd. So the compensation says again, it is 22nd. Again, for those products, compensation says they are saying until the loan and interest is being repaid, etc., they will be notifying the date later. So 22nd is what we can assume based on the press release and based on the press conference, but always is subject to disclaimer of the notification being there in the official gazette, and the language in the notification is exactly the same that of what they have said in the press release. That is something which you have to be very careful about. And in fact, we have some statistics of the GST Council deciding certain things. Right from 2017 onwards, there is a statistics which is available, what is not being implemented, but which has been approved by GST Council. So therefore, it is not that whatever circulars we have discussed about post-sale supply and other issues, not that you will get a circular and you will get exactly what is stated in the press release. There has been a consistent practice of various reasons. We do not know that what has been decided by the council has not been actually implemented. So yeah, that is the situation, and certain implementation would require amendment to the law itself. So which means it requires Parliament's assent. So we do not know whether those things we will be able to get by September 22. So we do not know. So unless and until with respect to the issues that we have spoken about, we get a very categorical circular or a notification or any other official document for the government, we cannot take it for granted, is what I would say.
Thank you very much once again, sir. I think we have covered, you all have covered almost every question. Now we can take some question answer session also before that. Thank you so much to all our esteemed panelists, Mr. N.V. Balaji sir, Mr. R. Parthasarathy sir, M. Saravana Prabhu sir, and Mr. J. Srinivasan for sharing such valuable insight with us today. We truly appreciate the depth of your perspective on GST 2.0 and its implication. Now we would like to open the chat box, or we'll start one by one for the questions from our participant. If you have any questions, please feel free to share in the chat box. Our first question is from, can we start with question answer, sir?
I think you can go through, I think some of those questions have been answered. I was going through the chat box. Many questions have been answered, but you can go through quickly and see if we have answered those questions, and if there are any new questions, we can look at it. Yeah.
All right, sir. Please tell us about changes in rate for dairy industry, major changes, sir.
Yeah.
Okay.
First question is from KV Mantu.
Yeah, I already given dairy industry. If you are talking about chapter 4, that's what is it. As I said, certain items like milk, which are already zero, now they have brought ultra high temperature milk and also our pre-packaged and labeled paneer also to zero duty. That is one important change. And other changes are condensed milk, butter and spread, and also cheese. All of these have been reduced from 12% to 5%. That's the broad chapter 4. If you talk about dairy products, these are the two major changes. So some of them have become zero, some of them are reduced from 12% to 5%. So wherever there is a zero, for example, if you are a dealer in UHT milk, then you will have input tax credit accumulated, which you will have to reverse, which we discussed under section 18.4, etc. So those things you will have to take care of. So these are the broad changes for the dairy sector. Yeah.
Thank you, sir. Next question is, sir, how accumulated cess will be adjusted from GST since earlier cess was 17% on big car? That I think we have already covered.
I've already answered. Unless there is a specific dispensation that GST compensation cess could also be used towards payment of GST in current, at least for some time to come, not for always, but some time to come. Otherwise, it becomes a huge cost for the car manufacturer because that cost has also to be passed on. So in fact, there will be no reduction in price of the bigger cars. That's how it's going to happen unless they do something on the compensations as well. Yeah.
Sir was pointing out, at least if they bring a clarity on this inverted duty refund applicability for this case also, it will be good.
Next question is from Mr. Yes Kalra, why 40% rate is applicable on bike more than 350 cc and car more than 1200 and 1500 cc? Are these seen goods or?
Yeah, one is these are all actually policy matters. Whether something less than 4,000 meters, less than 4 meters and greater than 4 meters cost has been there even in the earlier regimes also. Similarly, the idea is, yes, what we are promoting is two-wheeler is very, very important in India. But if you are buying a Royal Enfield Bullet or a Harley Davidson of more than 350 cc, you can afford to pay, therefore you pay tax also. That seems to be the condition. Similarly, you talk of an SUV of more than 4,000 and if you're willing to buy at 32 lakhs, why not pay another 10% extra tax? That seems to be the case. So it's generally policy, but 1200 cc for petrol cars and 1500 cc for this and sub 4 meters is what they considered as goods of mass consumption for which there will be a lower rate of tax. Similarly, motorcycles less than 350 cc is again generally 50, 100, 150. That's what most of them do. I'm giving you a lower rate of duty. That seems to be the policy, I think, thinking behind this particular rate differentiation. What is sin? Whether pan masala, for somebody who uses pan masala regularly, how is there a sin, you can ask. I don't think we have answers. These are policy matters. Yes.
Just to again add on to that, there's on a lighter note, all Harley Davidson from USAs are typically more than 350 cc, just to add context. Lighter note.
Yes, sir. Thank you for answering the question, sir. Next question is, sir, how this benefit to be passed on customers, particularly in FMCG industry, sir? Rate reduction benefit, sir.
So,
yeah.
I think we have addressed this issue also. We have addressed this issue both from the anti-profiting perspective. In any case, we said you have to pause on that. I think we have already answered that question as part of our reply itself.
Right, sir. Next question is, please tell us about GST reduction from 12% to 5% for food items and fruit juice puree concentrator with effect from 22nd September 2025. I think, sir, this question we have also covered. Next question is from Anvesh Ji. Currently in our company, we are in the middle stage where some invoices have been raised at 18%. From 22nd 9/2025, the applicable GST rate will change to 5%. In addition, for certain projects, invoices have already been raised where 50% payment has been received and the remaining 50% is due after 30 days as per the customer PO terms. Since invoices are already raised, please guide us on how to handle the situation and how to proceed with further billing as per the new GST rate.
Jayesh, you want to answer this?
Yeah.
I think that question is also answered by J. Srinivasan.
Yes, exactly.
In section 14, when he said about if goods have already been supplied and even invoices raised, whether you have received part payment or not, because the majority event has happened before, the old rate would apply. I think it's already clarified under section 14 how this would apply. Yeah.
I think the one question that they are trying to, the second part of the question, sir, what they are trying to say is 50% I have already received where I have paid 18%. Now the remaining 50% when I receive, should I, whatever 18% I have paid, will that become 5% for the entire value, or will it become 5% only for the remaining payment that is to be received? I think that is what they are
on the invoice. You have already raised one rate of tax, no?
Yeah.
The invoice has already been raised with one rate of tax. So you can't get a part payment for that at a lower rate or anything. That's why what you said, goods have already been supplied, invoice has also been raised before the change took place, which means it is the old rate. Therefore, receipt of payment becomes irrelevant, whether part or full. Therefore, it cannot change.
Yeah.
So Yashi, I think was asking the question. So just to clarify, there could be scenarios where one supply per se would attract multiple rates depending on advance receipts, so on and so forth. And one project covering many invoices could also attract different rates. So all these, I think JS was trying to point out, is really valid, and it could be very much possible. It may sound this one, but it is possible under section 14 as Parthasarathy.
Thank you for answering this question also, sir. Another question is, I have sold at 12% rate on 21st September, but I got sales return on 24th September. Now sales return would be applicable on which rate? I think this question has already been answered by JS, sir. It will be at original rate only, right, sir? The rate which was charged on tax invoice.
Yes.
So, but since this question is there, I'll just go back to the earlier question. Now, one thing that all members from industry who are there have to think about is really where section 14 talks about the actual date of invoice, whereas if you look at, because the project question was asked, it qualifies as a continuous supply of service. So where there's a due date of invoice is specified. Even otherwise, there are due date of invoice specified for various cases under 31. So what if you don't issue the invoice by the due date? If you issue it before, fine, you're in compliance with the law. What if you issue it after the due date of invoice? That's another question we'll have to take. So probably just to get the benefit of the lower rates, all these strategies, and will it constitute a violation under separate sections? So this interplay is there. So to clarify earlier point is this due date of invoice or actual date of invoice in section 14 is something that all members sitting here should really think about.
Thank you, sir. Next question is from Mr. Hariharan. Sir, we are supplier of starter to automobile component manufacturer of OEM. My question is, farm tractor are 5% and commercial vehicle tractor are 18%. Is it our component supply to farm tractor manufacturer can charge at 5%?
Sorry, can you just read the question again?
We are supplier of starter to automobile component manufacturer of OEM. My question is, farm tractor are 5% taxable at 5%, commercial vehicle tractor 18%. Is it our component supply to farm tractor manufacturer can charge as 5%?
That I will have to examine, because the starter motors will come under chapter 85. So under chapter 85, whether they have made a distinction between, they have only said electrical ignition or starting equipment of a kind used for spark ignition, compression ignition, for example, the generators. That's all that they have said. They have not said where they are used, and they have said they reduced from 28% to 18%. There they have not made a distinction between starter motors going in tractors, starter motors going, because starter motors themselves are not under 8708, they are under 8511. And under 8511, irrespective of end use, all this electrical ignition or starting equipment will be taxed at 18%, a reduction from 28%. That's all that will happen. So it will not have anything to do with the final application of that starter motor. That's what I'm seeing from the appendix of the 56th Council Meeting. If there is any other information available, I'll let you know. But as of now, this is the information which we have.
Thank you for answering this question, sir. Next question is from CA Nagateja. MSP, sir, please explain what is the mechanism for stock transfer without actual transfer of stock to the manufacturer.
I think this one comment came across wrongly. So I'm not saying invoice without supply. So I'm saying if you look at provisions of section 10 and also section 12, if I am right. So there is a small provision in the law where, we can say there are two things. It's a genuine sale. Genuine sale is happening. There is no doubt about it. So there's a question of possession being handed over. There's a question of delivery being given also. So possession can be constructive possession also. So therefore, without going too much into the strategies, so for want of time and this one, so a constructive portion could be given, and therefore from that one you can invoice it. It's very much permitted within the law. Just for your reference, Section 10 of IGST and Section 12 of CGST Act and general law for that matter. Constructive portion is recognized even in income tax law and various such cases, so on and so forth. It's a general law concept. So therefore, that is what I'm trying to point at. So don't get me wrongly. So your question is worded as though I'm asking you to supply what is that? I mean, invoice without supply. Please don't get me wrong. So we do not encourage any of that. So I'm just talking about the niceties of law, where I was again saying legally permissive provisions which are there. Where see, this is a pain point. See, if given a chance, the SDs or local sales office located nearby, you would might as well send the goods to them, get it back. If it's not going to be, see, it's just because of this, let's say interstate supply, you can't send all goods all the way back from Gujarat to, let's say, Chennai and get it back, and it's just for the sake of reduction in law. In fact, from our end, from our organization, through our channels and the government, we have also given suggestions that there's a concept of credit on transfer document. This is not a new concept. Tran 3A, probably they will also know about this. So Tran 3A was there earlier, wherein certain specifically you can identify those goods. Where in the initial transition of GST law, in 1st of July 2017, this credit transfer document was permitted. You instead of sending back the goods, reverse football you are playing, instead of sending back the goods, you can just send back the credit. This is a very simple solution which government can give. So nobody wants to evade taxes, but they don't want to incur this cost of sending the goods all the way back and getting it back once again just for merely availing the lower rate. So there probably, if there is no such credit transfer document being visualized in the later amendments which come, then as a worst case scenario, then probably we'll have to think whether we can use such niceties of constructive portion and try to mitigate this cost is what I'm trying to say. So don't get me wrongly, again, legally permissible solutions is what we are trying to say.
Thank you for answering this question, sir. Next question is, I have a question regarding hotel industry IT reversal. Can I be proportionate to the 18% revenue? Can it be the proportionate to the 18% revenue? Not able to get.
Yeah. See, the one thing we have to again give a disclaimer on hotel is they are not made very clear. The reduced rate of 5%, is it a mandatory rate or an optional rate? Because we have two categories in terms of notification number 1/2017, where there are certain categories of supplies where you have an option. Either you go for 5% without credit, or you go for 18% or 12% with credit. It is not very clear in the press release as to whether it's an option or it is a mandate. Because if you look at real estate simply do not have an option. They have to go for 5%. So we have to wait, first of all, to see whether this is an option or a compulsion. Only then you will come to the reversal of credit or otherwise. So we will have to wait for the notification, actual notification, to see the applicability of 5%.
Next question is from Mr. Subramaniam. I would like to know more on the procedural aspect of applying inverted duty structure. I think it can be discussed in detail with on one-to-one basis also. Next question is again from Mr. Anvesh. Thank you for your clarification. My second question is, what are the recent changes in GST rate for solar companies, especially for solar module, inverter, civil consumable, electrical consumable, and electrical cable?
Individual items, I don't know, but for generally for renewable energy, there is a reduction in rate for 12% to 5%.
5%.
Where they have specifically covered the various renewable energy devices, which were earlier also there. It's not that whatever is earlier at 12%, which is the biogas plant, solar-based power devices, solar power generator, solar lantern, etc., photovoltaic cells, whether mounted or not, etc., all of them which were there earlier at 12 have become 5. So other than that, there are no other changes as far as the solar issue is concerned.
So just to complement Sir's point, this rate was originally at 5% pre 1/1/2020. It again increased to 12% after 1st of January 2020. And if I'm right, my dates could be a little off there, but if I'm right, this is the date. And now it has come back to 5%. So this also has to be read in tune with various people who are doing EPC contracts also of these thing, wherein the 70/30 mechanism prescribed in the law, read with notification 11 of 2017 also, for those who are doing composite supply of both goods as well as power project EPC contractors, to be very precise. So for them also, this will have a lot of impact, wherein now they go back to, for the 70% component, the rates go back to 5% from earlier 12%. It was originally at 5% before 1/1/2020. It was a very welcome thing, I think, considering that relief is.
How much service, how much good, that remains from the earlier one. Yes. All that happened, rate has reduced from 12 to 5. That's absolutely all. Whatever 70/30. Absolutely.
70/30 remains, yes, sir.
Yeah.
Thank you, sir, for answering this question. Any specific changes to telecom sector, sir, under GST 2.0?
There isn't anything very specific to telecom as such. Of course, for constructing the tower, etc., if you use cement and other items, yes, 28 to 18 is there. Otherwise, specifically, you don't have as such anything specific to telecom, I would say.
But surrounding this GST 2.0, last 1 year, there have been so many landmark changes. But anyway, that's not the scope of the discussion. As 2.0 does not seems to be there.
Thank you very much, sir. I think we have covered all the questions well within the time and covered all the areas also. So for any specific query, we'll share our email ID, etc. So for specific detail, we can share on that. So on behalf of Shreyas Global, I would like to extend my heartfelt thanks to all our distinguished panelists, Mr. N.V. Balaji, sir, Mr. R. Parthasarathy, sir, Mr. M. Saravana, Prabhu, Mr. J. Srinivasan, for taking the time to share their deep knowledge and practical insights with us today. A big thank to all our participants for joining us virtually and making this session engaging with your presence and questions. And finally, special thanks to the Shreyas Global and the entire team for organizing and hosting this important discussion on the 56th GST Council Meeting, Key Highlight and Implication GST 2.0. We hope this session has been informative and valuable. Wishing you all a great evening ahead. Thank you very much.
Thank you, Ramanujan, for
Thank you all.
And thanks to
Thank you
Delhi
for
team.
moderating it. Yeah.
Thank you, everyone.
Specifically to Delhi.
Thank you once again.
Team. So.
Thank you.
Thank you. Bye.